I don't want you to look back in 20 years and say, wow, I didn't have this information. I wish I had that information and I would have made different decisions. Hey guys, what is up? Thanks for tuning into the channel again today, and I'm super pumped. I'm going to tell you exactly why stock markets crash. And if you're scared of the markets, or if stock market crashes worry you, they concern you, then you really need to watch this video, because I'm going to go through the principles and basics of why stock markets crash, what you need to know, and what you can do to prepare for a downturn. So first things first, stocks have been one of, if not the best wealth generator of the 19th and 20th centuries. If you're not partaking in it, then you really need to ask yourself why. In today's technology era, there's no reason not to be informed about something or not have proper information, because you can get information anywhere. You can get it from YouTube, you can get it from the internet, you can get it from books. Probably highly recommend books or watching someone that's done this before and has their own financial freedom and knowledge on it. FYI, I do. Alright guys, so here I'm just going to quickly show you an S&P 500 chart from 1988 all the way till today. We started at 225 and now we're over 3,800. So you can imagine the growth of $1 had you invested in 1988, 30 years ago, and how much it would be worth today. So even with the two biggest crashes in the last 30 years, you can see the tremendous growth that you would have still had if you invested in the stock market. And here we go. Here's a list of all the years and the increase or decreases from 1988. What you can notice here about the crash of 2000, and you also had a crash of the recession of 2008, 2009. So notably about the 2000, that was the tech bubble crash, which was famous for creating one of the biggest bubbles ever, because technology was just kind of getting going, the internet was just kind of getting going, and people were investing so heavily into these stocks. And then overall, it led to just everyone and their mother investing into all stocks and everything. So that led the S&P 500 to grow from 470 in 1995 all the way to 1400 in 2000. So you can notice that you had a 31% increase in 95, 23%, 22%, 31%, 19%. Over these 5 years, you had 126% return, which is ridiculous, astronomical, and when you look back and take this all in, you kind of think, okay, that is unreasonable. That was never expected to happen. And say the revenue and the companies of the S&P 500 were growing at about 10% per year. That means instead of what should have been 50% was 126%. So at one point or another, you're going to hit a reversion to the mean. That's just standard deviation. That's statistics 101. So what you should know and realize though about this crash is, one, it was warranted. You had a way too high of a run up, and ultimately that's why we get a crash here. But had you invested in 95, and even after this 3-year period of crash, which by the way, it crashed about 45% or so, and that's pretty fortunate because the actual tech stocks, some went 99% down, some went bankrupt, and that's just kind of the important part of diversification and knowing what you're investing in. But had you invested in 95, at the end of the 2002 period, where you had a 22% decrease that year and 45% overall, you still would have averaged at 10%. So really, ultimately, the market just went back to the mean and to the average. So that's pretty interesting to note, and that's something you should realize when you look at historical crashes and you get fearful and you don't know when another crash is coming. Just remember, we kind of always revert to the mean. So in 08-09, we kind of had the same thing, although it was more economics and what was going on with the financial crisis and everything. If you still look from 95 all the way to the end of 2008, where you had a minus 37% down, you still had a 7% average return over all those years, when you even through the two biggest crashes of our generation. So it's pretty interesting and humble to note that even with those crashes, you still would have earned 7% average, which is pretty phenomenal. But it even gets better because from 95, if you would have held it up to today, you're looking at about that 10% average return again, and kind of going back to the mean or the average. Alright, so I have this chart here, and I basically plotted the annual return of the S&P 500 over this chart, and I have the 10% annual average over the last 30 years. So you can see typically you'll have a couple years above and a year or two below, and it's quite stable in terms of, any time spent above the mean, you're going to see kind of that true reflection below the mean. So here we had 5 good years way above the mean, and basically that led to a few drastic years below the mean. And then we have a nice year above the mean, and we kind of get just some below average but close to the mean. And then you see these big spikes up in here, but ultimately we have an even space of above average and below average, which should give you a little more confidence of why stock crashes happen and why everything eventually has to go back to a mean or an average. So now we've seen this with GameStop, AMC, BlackBerry, and some other companies where investors are piling into these stocks that fundamentally have no business being at that price. So disclaimer, I love this story, and I love that Wall Street is cringing and they're experiencing big losses, because I think they've manipulated the market for so long and they've done this by themselves. And it's nice that individual investors are taking part of this, and I think this is going to change how the stock market works forever. So one thing you can do, as Warren Buffett says, is be fearful when others are greedy and greedy when others are fearful. So that means don't follow the herd. If stocks are running up historically high, then back off a little bit and don't put too much money in at that time, because we know at some point we're probably going to get a reversion to the mean. Second is dollar cost averaging. Dollar cost averaging is a great way to take your emotions out of the picture and invest the same contribution regularly at the same intervals, and that way you get the highs but you also get the lows. But while doing this, it's actually quite amazing, because your same, say, $100 a month actually buys more shares when the prices are lower and less shares when they're higher. So this is exactly what you want to be doing, and this is a great way to do it and take your emotions out of the picture. Third thing you can do is just maintain proper allocations to stocks and bonds. So in a big run up, your stocks are going to become a bigger part of your portfolio than your bonds, and you want to reallocate that to maintain the same weighting, say once a year, twice a year. Say if your goal is to be 80% stocks, 20% bonds, or 70% stocks, 30% bonds. When stocks go from 70 to 75% of your portfolio because they've run up and the prices have gone higher, then you'll want to reallocate that and sell some of your stocks and maintain that even 70-30 balance in your portfolio, or whatever you choose. Don't lose focus on what your goals are and what you're trying to accomplish, and don't listen to everybody on how much money they're making, how they're doing, what the next big stock is, and what the next big boom is, because most of the times you're coming in too late and you're gonna lose your shirt. Anyways, I hope you guys liked the video, and I hope it was informative for you and you can make better choices with this information. Please subscribe, please turn on your notifications, as there will be more videos to come, and I'm excited to teach you a lot more. Thanks guys.